Let's continue our journey and look at different accounting errors and how we would go about correcting them. So below are three independent and unrelated errors, A, B, and C. So we're going to look at each one independently and do all of the items required for each item, and then that way we won't get them confused. So let's start with A only. On December 31st, 2017, Wolfbach Corporation, we'll just call them Wolf, failed to accrue office supplies expense of $2,300. So in other words, they have these office supplies, they've used them, they just forgot to expense them. In January of 2018, when it received the bill from its supplier, Wolf made the following entry. They debited office supplies expense for 23 and they credited cash. Now that was done in 2018. So let's pull up, get a little journal page out so that we can work through this. So here's what the company did in 2018. They hit office supplies expense for 2,300. And they hit cash for 23. Is this an issue? Well, absolutely. Remember, expense recognition states we must recognize expenses in the time period they generated revenues. These supplies were consumed in 2017. Therefore, the entry should have been made, or the expense should have been recorded last year. So what entry should they have made in 2017? Well, they should have debited office supplies expense for the 23, and since they had not yet paid for them, they should have hit accounts payable. So anytime I'm looking at errors, I like to go back and say, wait, what should they have done in each of the periods? Then in 2018, what should they have recorded? Well, in 2018, they should have simply paid off the liability. So the liability would go away, so that's not an issue at this point, and the cash would go down. So how are we going to go about fixing this issue? They've got office supplies expense this year that should not exist. It should have been in a prior year. So how do we fix it? Well, let's talk about each of these. For number one, how is our income statement impacted? Well, the income statement, our expenses were understated. Okay, we did not report enough in office supplies expense in the prior year. If our expenses are understated, then what else is going on? Well, our income, bottom line income, when expenses are understated, income is overstated. Okay, so that's the problem with our income statement. Now, what's wrong with our balance sheet? Well, on our balance sheet, what are we missing? Well, let's go back. Notice in 2017, we didn't record anything. What were we missing? Well, we were missing the expense and we were missing the payable. What is a payable? It's a liability. So our liabilities then were understated as well. We did not report liabilities that we did have of 2,300. What else is going on our balance sheet? Anything else? Well, remember, anytime income is under or overstated, so is retained earnings. So our retained earnings here would actually be what? Overstated as well. Very good. All right, so that's our two issues with our income statement and our balance sheet. All right. Now, how would we fix this? In 2018, how would we go about fixing the issue? Well, keep in mind, as of 2018, the liabilities are cleared. There is no issue with our liabilities at this point. What's our issue? Well, our issue is we've got office supplies expense that we debited for 2,300. So what do we need to do? Well, that's a current year issue. So we need to credit the office supplies expense because we should never have debited that account this year. And what do we need to fix from last year? Well, we need to correct our expenses. But remember, from last year, anytime we need to correct an expense or a revenue from a prior year, can we hit the expense account? No, anything from a prior year, temporary account-wise, has to go against retained earnings. So just keep that in mind. I don't think this chapter is difficult in that respect, but you've got to remember some of the basic rules. If you are adjusting a prior year temporary account, revenues, expenses, gains, losses, dividends, you have to hit that against retained earnings because those accounts were closed. They were forced to zero at the end of the period to start the new year. Okay? Now, I know we said, wait, why are we hitting the expense? We're not fixing the expense here from prior years. This is the current year expense. Notice in 2018, they hit this expense that should not exist this year, so we need to actually remove. Since this is from 2018, the current year, we are allowed to hit the expense because it's not been closed yet. Okay, so we're correcting a current issue in that account. All right, so that's the first issue. So let's move on. And I'm going to sort of delete out my entries here because we're going to do this next one. Error B. On the last day of 2017, Midwest Importers received a $100,000 prepayment from a tenant for 2018 rent of a building. Midwest recorded the receipt as rent revenue. Is that a big deal? So what did they do? So let's scroll down and let's look at what they did. So let's go here. What did they do in 2017? Well, they received money. So they hit cash and they received $100,000. We know that they received a payment, so we know they received cash. Now, what did they credit? Well, it says Midwest recorded the receipt as rent revenue. So in 2017, they recorded rent revenue. Should they have recorded that? Well, let's talk about what should they have recorded in 2017. Let me put the correct there. What should they have done? Well, cash is correct. They did receive $100,000. That's not an issue. But what should they have credited? Well, think about the revenue recognition principle. Now, I know it's a big principle, but let's just talk about the basic concept. Revenue is recognized when the obligation is complete. So when we received this $100,000 in 2017, had we done anything to actually earn it? Is our obligation to our customer complete? Absolutely not. We've done nothing to earn that money. So what would we hit? Well, we would hit deferred revenue, or another word for that is unearned revenue. So our deferred revenue would be hit for $100,000. So notice, what's the issue here? Well, we hit revenue in 2017 that we should not have. Okay. So from an income standpoint, our revenues are overstated. Okay. Why is it overstated? We recorded an increase in rent revenue of $100,000 that should not exist. So we recorded too much revenue in 2017. If revenues are overstated, what happens to our bottom line net income? Well, anytime a revenue is overstated, the income is going to be the same overstated. So here's the example we talked about in the last video. When expenses are understated, income is overstated. When expenses are overstated, income would be understated. So notice when an expense is wrong, the opposite is the problem with income. When revenues are wrong, the same direction is our income. Okay, so revenues are overstated, income's overstated. If revenues are understated, income would be understated. So keep that in mind when you're thinking about the over or understated and how to fix items. So this is 2017. Revenues were overstated in 2017. Now what's wrong with our balance sheet? Well, we hit revenue. We should have hit deferred revenue. What type of account is deferred revenue? It's not a revenue account, it's a liability. So we're missing a liability here. So our liabilities are actually understated. Okay, our liabilities are understated. What about our retained earnings? Well, we've already said income was overstated. So if income's overstated, retained earnings are also overstated. So keep that in mind as you go about when anything happens to net income, retained earnings will be impacted by the same amount on our balance sheet. Okay, so we've gone through what's wrong. How are we going to fix this issue? Okay, what are we going to do in the current period? Well, one, I need to fix last year's revenue. We overstated our revenue, so I need to go in and reduce my revenue. So how would I do that? How would I get rid of rent revenue from 2017? Well, in 2017, I would have to go in and I would have to hit retained earnings because remember that rent revenue has already been closed out to retained earnings. So to reduce the revenue, we would debit. So we're going to debit retained earnings. Now, what do I need to credit this year? Well, at this point, it says, have we earned it in 2018? Yes. So in 2018, notice we've now earned this rent. So you could do two entries to fix this issue because really what would happen in 2018 is we would then debit deferred revenue for the 100 because we would earn all of that in 2018 and then we would credit the rent revenue this year. So how do we fix it? Well, we could do an entry where we actually put all this into deferred and then reverse it out. So right here, we could just put all of this 100 into deferred and then reverse it out. But what's the logical step? Well, notice deferred revenue is already going in and out. So deferred at the end of 2018 is not an issue. Liabilities fix themselves. So what's our issue? Well, I need to recognize rent revenue this year, not last year. So I can go in and hit revenue. Again, you could do this in 2 entries. So what would the 2 entries look like if we did do it in 2 entries? Well, in 2018, what you could do is you could go in and hit retained earnings. You could do retained earnings to fix last year's issue. And then you could credit deferred revenue. And then in the same year, you would need to debit deferred revenue for that 100 to get rid of it because you've earned it. And then you would hit your rent revenue. I would say it would be about timing. At the time we found the error, if we had not yet earned the rent, we may want to do this option where we put it in to deferred instead. And that way, when we actually earn it, we would then cancel it out. So let's say that 100,000 covers all of 2018. We found the error in April, for example. We may want to move it into deferred and then recognize only the portion that we need to for this year, especially if we create monthly financials or need to do maybe a quarterly SEC report, things of that nature. So it could go a couple of different ways. We're going to hit it straight to retain because we're assuming we're at the end because it just says for 2018. And bottom line is our retained earnings needs to go down by 100 and our rent revenue for this year needs to go up by 100. So that's the bottom line impact. So that's what we're going to journal there. All right. Last one. Let's look at C. At the end of 2017, Dickens Lowry Corporation failed to accrue interest of $9,000 on a note receivable. At the beginning of 2018, when the company received the cash, it was recorded as interest revenue. Interesting. So, what happened in 2017? Well, let me erase all of this. 2017, what happened? Nothing. We didn't record a single solitary thing in 2017. Absolutely nothing. So what did we record then in 2018? Well, in 2018, we recorded cash of $9,000 and we recorded interest revenue of $9,000. So that's what actually happened, okay? Now, what would be the correct way to do this? Well, the correct way for 2017, we needed to have accrued this interest. So we would have hit interest receivable. Sorry, that's still red for $9,000. And we would have hit interest revenue because we needed to earn that revenue last year. Okay, let's pull this up a little bit so we can get more into the screen. And then in 2018, what would happen? Well, we would get the cash in for $9,000. And then we would hit interest receivable. So what's wrong on our books here? Well, notice interest receivable cancels out. The cash is received, so cash is fine. The only issue is this $9,000 that we recorded as interest revenue this year should have been recorded last year. So what do I need to do? Well, I put it in to interest revenue this year. Should I? No. So we need to fix this interest revenue. So step 1 is to fix that interest revenue. And then step 2 is figure out what the offset would be. So let's talk about how is this issue impacting us. So keep in mind, this up here is what we did do. So let's highlight it in a, let's go in orange. Down here is what we should have done if our accountant had done this correctly. Okay? Maybe we need to hire a new accountant. They're making all sorts of errors. So this was the correct way. So let's talk about this. This is what we did. This is what we should have done. What's wrong with our financial statement? So let's start with our income statement. Well, we did not accrue revenue. In other words, we didn't accrue any interest. So that means our revenues are understated, and this was interest revenue. So if you fail to record revenues, they're understated. If our revenues are understated, what's wrong with our net income? Well, net income is also understated. We did not report enough in earnings, so therefore net income is understated. What else? Well, what else did we miss? So let's go back. To my journals there. What else did we miss? Well, in 2017, notice we should have had a receivable on our books. What type of account is receivable? Well, receivable is an asset, so let's just drag that off to the side. So that means our assets were understated as well. We did not include an asset that we should have included on our balance sheet. If assets are understated and income is understated, then what's wrong? Is there's something else has to be offsetting that? Well, anytime income is impacted, so is retained earnings. So let's go to our retained earnings. Our retained earnings is under or over? Well, in this case, retained earnings will be understated. Okay. So that's sort of the impact on the financials. How are we going to fix it? Well, we've already talked about one piece of it. Notice we recorded interest revenue in 2018 that should not be there. So how do I fix my current interest revenue issue? Well, we credit revenue, so to fix it, I would need to debit. So that's step one. We're going to debit our interest revenue for the $9,000. Now, what else is wrong? Well, the other thing that's going to be wrong is my prior year's retained earnings. Because this interest revenue didn't get closed to retained earnings, my interest receivable is fine now because I've collected it, so my assets have corrected themselves. The only issue is my prior year income. So how do we fix prior year's income? Well, anytime you need to fix revenues or expenses from a prior year, you have to hit retained earnings. So we need to reduce our retained earnings, our revenues from last year. All right, so this is just an example of how to go through an error. Again, I don't think errors are difficult, nor are changes in estimates or any of those. But the problem is just stopping and thinking about what's the impact and how do we correct the current year's information so that we're reporting the proper number. And so you really have to analyze the error to see what's going on. I hope you all have a wonderful day.